Sean Haney here with RealAgriculture.com, and right now I'm joined by one of my colleagues at Real Ag, Kelvin Hepner. How are you doing today, Kelvin?
Doing pretty good today, Sean.
We always talk internally about these numbers that come out from AEM every month. And we thought we would record a bit of an audio podcast here to discuss the numbers. The April numbers are out. And so what the AEM machinery retail numbers show is how is the machinery segment performing in the two-wheel drive, four-wheel drive, and combine segments? As of the end of April, is there anything that sticks out for you?
It's not a pretty picture right now when it comes to equipment sales, both in Canada and the U.S. That's for sure.
Yeah, I guess one of the things that stuck out for me right away is that in Canada, the tractor business really sucks right now.
Yeah.
Two-wheel drive tractors are down 18.4% year to date in comparison to last year. Four-wheel drive tractors are down 22%. That's a weighted number of down 18.6. That's ugly.
Yeah, and that's already after similar decreases last year. So this is only comparing to 2015. So when we look at 2015 as a down year already, it's been a steep decline from some of those big years, 2012 to 2014 in there.
Yeah, and every month when I look at these numbers, I always jump to the four-wheel drive tractor, right? For some reason, but there's actually a lot more two-wheel drive tractors sold. So that will change the total tractor number a little bit. But combines, really, really interesting. Combines, year-to-date comparison to last year, are basically flat. They're up 1.8%. Are you surprised that combines aren't down as much as tractors would be?
Yeah, I'm not quite sure what the explanation for that would be, because you'd think most of the same trends would apply to combines, other than maybe people still trade in their combine every year and choose to keep their main horsepower tractors longer, that kind of thing. I'm not sure what the explanation would be.
Well, in the U.S., so while we're flat or up 1.8% in combines year to date, in the U.S. it's down 26%.
Yeah,
very ugly.
Huge.
Yeah, so here's one of the. So I did a bit of research. I did some phoning around. One of the people I talked to is I talked to Rocky Mountain Equipment, and it's the largest machinery franchise or retail chain in the West. They're a good place to start when you talk about this kind of stuff. And one of the things that I thought is that with the low Canadian dollar, we would be shipping way more equipment south. But they said that's not actually the case because the lack of financial farms in the U.S. are actually struggling more than in Canada. And the used market domestically is what's really keeping a lot of, really providing some good financial returns for different machinery companies.
Yeah, and Canadian dollar currency, I think, is probably a big part of this picture too. Why our numbers are down. U.S. numbers, of course, are, but of course, most of our equipment comes from the U.S. And so it's being priced, and we're coming off January when the dollar was down wherever it was in the 60-cent range. So perhaps some of these numbers could return, maybe rebound as we get later into the year, but the growing season is underway, and many of those acquisitions are made during the winter. So we'll see. But the dollars bounce back. Maybe we'll see. Maybe the worst is over. I'm not sure.
Well, we've clearly seen a lot of consolidation and the collecting of brands during this downturn in the machinery cycle. Great Plains, Monosum, Precision Plant, Hagee. There's a lot of brands trading around here. So clearly earnings, this is what happens when earnings are a little bit lower. Companies with cash tend to spend it and, collect some new assets. So it's going to be interesting how we move out of this cycle in the future here.
And all four of those companies you mentioned are kind of in that intermediate, been around for a few decades. They're based in most of them in the U.S. So, yeah, they're getting into tough times. One thing that's interesting, I think, if you look at Canadian companies, so far we haven't seen any major mergers or acquisitions in some of the Canadian companies that would fit the same description. So, although they're sourcing most of their materials, I'm thinking in U.S. dollars, perhaps the currency effect not affecting Canadian companies as well. At least speaking to some local businesses, it seems like their sales, particularly Canadian sales, are doing okay. So Bueller Industries, for instance, just released their quarterly numbers, and they're down like everybody else is, but they are still seeing some sales into overseas, into Europe, and Canadian sales are looking steady too. And Elmer's Manufacturing, that's a local grain cart and harrow maker in my neck of the woods here in southern Manitoba, and they're still seeing strong sales from what I hear. So it's interesting how the currency effect, I think, is having making it a different story for Canadian companies versus U.S., although nobody certainly having an easy time right now.
Yeah, it's a good point about some of the Canadian manufacturers. Obviously Seed Hawk was already acquired by Vaterstad, so that one's kind of off the table, I would say, at this right now.
Yeah.
But we have, MacDon's been for sale forever. We also have other companies like Seedmaster and Morris that haven't heard any sort of rumors about at all, and they've kind of continued to work independently. So it's going to be interesting. We'll definitely talk when we get the May numbers and see how our year-to-date numbers, if they are still trending in the going lower, or if they're starting to turn around.
Yeah, and some of those companies you mentioned have laid off workers, and I think everybody has cut inventory, and that's they've cut production, so inventories are being drawn down right now. But certainly we haven't seen some of that activity in terms of acquisitions that there has been in the U.S. so far in Canada.
Talk to you again soon, Calvin.
Sounds good.